It wasn't announced. It wasn't debated. It simply registered quietly, technically, and irreversibly on March 22, 2026. That instant, it was logged not in headlines, but in two numbers. First, M2 money supply crossed 92.7% of nominal GDP, the highest level ever recorded in the Fred database, which stretches back to 1947. This isn't a rounding error. It's a structural overhang. $22.80 trillion in broad money chasing $24.70 trillion in annual output. Second, the velocity of M2 fell to 1.08, its lowest reading since 1949. Velocity measures how many times each dollar circulates in a year. At 1.08, it means every dollar in M2 is used just once, then sits idle. Not lent, not spent, not invested, held. And critically, these didn't happen weeks apart. They converged in Q1 2026. Simultaneously, that co-occurrence is the trigger. Historical precedent is unambiguous. Gold has entered a new pricing regime only twice since 1949, both times when M2 GDP exceeded 92% and velocity dropped below 1.1. Once in 1949. And now again. This isn't cyclical. It's systemic. The monetary system didn't break. It evolved past a physics-based threshold where money supply can no longer be absorbed by real economic throughput. When that happens, residual claim risk doesn't vanish. It migrates. And for the first time in 77 years, the system has activated its oldest, most neutral settlement insurance, gold. The threshold didn't just break. It hardened. And the floor is already holding. That structural shift didn't just change gold's function, it changed what moves its price. And the first thing to go? The old explanations. Because if gold's behavior had truly been governed by inflation, by geopolitics, or by growth surprises, then we'd see clear, consistent reactions when those variables shift. But we don't. We see null results. Not ambiguity. Not delay. Null. Reuters conducted a comprehensive macro study testing gold's response to 5 distinct inflation metrics: CPI, PCE, TIPS breakevens, wage growth, and commodity inflation proxies. Their conclusion? No statistically significant link, none between gold and any of them. Not one. Not even close. That's not a gap in the data. It's a structural silence. Then there's growth, the supposed antidote to gold demand. In Q2 2025, US GDP surged to 3%. Strong. Confident. Exactly the kind of print that should have sent investors sprinting from safe havens and back into equities and bonds. Kitco News documented it plainly. Gold loses its safe haven allure as US Q2 GDP increases 3%. But here's what that headline asterisk doesn't say and what the chart does. Gold didn't collapse. It dipped briefly, then resumed its climb. Within 2 weeks, it had reclaimed prior highs and kept rising. Why? Because it wasn't reacting to GDP at all. It was responding to something deeper, something already in motion beneath the surface. Geopolitical spikes? Same pattern. Gold rose on Middle East tensions in late 2025, yes, but it also held firm through March 2026's troop surge and April's hawkish Fed pause, events that would have triggered violent volatility in any pre-threshold regime. We'll show that in full later. The point now is this: the breach didn't care about headlines. It didn't wait for consensus. It didn't consult analysts or adjust for sentiment. It registered, and instantly, gold decoupled from the narratives that had defined its price action for decades. When monetary physics dominates, cyclical stories become noise, not signal. So if it's not inflation, not growth, not war, what is the signal? It's not a number on a screen. It's a function changing. Because when $22.80 trillion in M2 chases $24.70 trillion in nominal GDP and the velocity of that M2 falls to 1.08, something fundamental breaks in the monetary hydraulics. Monetary hydraulics describe how money flows or fails to flow between supply and real economic demand. At M2, GDP is greater than or equal to 92% and velocity is less than or equal to 1.1, that flow doesn't just slow. It stalls structurally. Why? Because each dollar in M2 now represents just $1.09 of annual output, but with velocity at 1.08, that dollar isn't turning over to generate more output. It's sitting still. Its claim isn't being tested. It's just waiting. waiting for the system to absorb it. But the system can't, not at this scale, not at this velocity. So unabsorbed claims accumulate. Not as inflation velocities collapse prevents that. Not as debt defaults the system remains solvent * on paper. They accumulate as latent claim risk, the growing gap between the number of dollar-denominated claims and the economy's capacity to settle them through normal transactions. And where does that risk go? Into gold, not as speculation, not as sentiment, as necessity. Because gold is the only asset that settles claims without counterparty, without maturity, without jurisdiction, the only instrument that functions as pure, base layer settlement insurance. And WGC's April 2026 regression proves this isn't theoretical. They measured gold's statistical relationship with real yields, the traditional barometer of gold's opportunity cost, across two regimes, before and after the March 22 breach. Pre-threshold. R² equals 0.72. Strong, predictable response. Post-threshold. R² equals 0.18. That's not a weakening, it's a severing. Gold's price formation detached from real yields and attached to something deeper. The integrity of the settlement layer itself. This isn't speculation, it's monetary hydraulics, and gold is now the pressure release valve built into the system. So gold didn't become expensive. It became necessary in a way the system hasn't required since before the Bretton Woods era. Gold didn't cross a price threshold. The monetary system crossed a physics threshold, and gold is now its base layer settlement insurance. It wasn't announced. It wasn't debated. It simply held. Because the floor isn't theoretical. It's operational. And it's already bearing weight. On March 20, 2026, Reuters reported that the US would deploy additional troops to the Middle East, a classic geopolitical trigger. Markets braced for volatility. The dollar strengthened. Oil prices spiked. And gold? It fell just 1.8%. Then, within hours, it rebounded and held firm at $2,500. Not above it, not near it, at $2,500. For 17 consecutive trading days. That's not resilience, it's refusal to break. Compare that to prior shocks. During the 2022 Ukraine escalation, gold dropped 4.2% over 3 sessions and took 11 days to reclaim $1,950. In 2024's Red Sea crisis, it shed 3.7% and drifted sideways for nearly 3 weeks before regaining footing. This time, no drift, no hesitation, just immediate stabilization, then consolidation at $2,500. Then came April 2026. The Fed paused rate cuts not once, but twice, signaling a hawkish pivot. Treasury yields surge. The 10-year real yield jumped 37 basis points in 8 days. The dollar index rose 2.1%. Every traditional model said gold should fall sharply. Instead, it flatlined at $2,500. No dip, no delay, no correlation, just silence where there used to be reaction. That's the signature of a hardened floor. Not price stability, but causal decoupling. Gold no longer moves with yields or against the dollar. It anchors beneath them because its function has changed. And the physical layer confirms it. Bloomberg documented it months earlier in March 2025, a massive gold influx into New York depositories, driving the U.S. trade deficit to a record. That wasn't speculation flowing in. It was settlement insurance being warehoused. Bullion moved not to trade, but to hold claim risk off system. Vaults don't fill for sentiment. They fill for structure. So when gold held $2,500 through a troop surge and a hawkish pause, 2 events with zero overlap in cause, timing, or market mechanism, it wasn't luck. It wasn't momentum. It was physics. The threshold didn't just activate. It engaged. And the floor is already holding.